Joining me now is Chip Hughey. He's with Truist Wealth, and I want to bring him in. He's the managing director of fixed income at that particular firm. Chip, it's great to have you on the show this morning, and we should probably start with the most recent news, which is actually a response now from President Donald Trump that he does want to see the Fed lower rates. What does this mean for the fixed income space?
Yeah, first off, I think that the Fed is going to maintain its independence and is going to make decisions based on what it believes is our current economic outlook. So I think that the Fed is doing the right thing because it's really the only thing that the Fed can do right now. The Fed is in a tough position and should be in wait and see mode. In a vacuum, I actually think the Fed would be discussing, when it's appropriate to ease policy a bit more. But with so much fiscal and trade policy unknowns, they simply can't do that, and they need to stand pat and wait for a bit more clarity.
Yeah,
we do still think the Fed is in restrictive territory and can fight inflation, and is also well positioned to react to further weakness. But ultimately, we do think that the Fed will deliver 25 basis point rate cuts by year end, starting around mid-year.
Interesting. How do tariffs factor into this equation? Because one thing that market participants are watching closely is this April 2nd date, right? Some of the tariffs on Canadian and imports from China as well are on pause until April 2nd. How does that change the inflation landscape?
Yeah, I think that's exactly what the Fed is waiting to see. And so I think that the impact on both demand and inflation is a bit unknown. We don't know the scope, the timing, the magnitude of tariffs just yet, and that is what is keeping the Fed on hold for now. It could be a sort of a one-time adjustment in prices higher. That would not be really sustainable inflation. If we get into this more escalation of trade war, back and forth, that could have more sustained inflationary impacts. But that's what we don't know. And so that's why the Fed continues to stay data dependent, focused on the data that's coming in and waiting to see where this policy ultimately lands.
It's interesting, Chip. We've had several markets guests actually raise their expectations of rate cuts this year as Donald Trump. I think many people thought the tariff talk was a negotiating tactic before he took office. There was about a 2-week period of calm before the trade war did really ramp up. But some people have expected more rate cuts in the wake of this escalating trade war. What would cause you to change your own outlook on the amount of rate cuts that we get this year?
I think what that would take is, right now we have seen some cracks in the softer data, right? Consumer sentiment, things like business surveys, a little bit softer type of data that is coming in. If that translates into more clear weakening in hard data, inflation, the labor market, GDP, that is when what we're seeing now as far as expectations is actually having a real impact on the economy. I think that's when you would probably need to revisit the rate cut expectations. But I will say, we're going back to last year when the market was expecting really rapid rate cuts. We thought that the Fed was going to work with this sense of scar tissue from this inflation that they've just combated for some time, and would go slowly. And certainly, so coming into 25, we thought the Fed would be a bit slow, and then also this uncertainty around tariffs is adding to that gradual playbook.
It's interesting. I do want to play remarks that we heard from the Fed chair yesterday, Chip, on this very topic, how to basically reconcile the soft data with a meaning for the hard data. Let's take a look at what Fed Chair Jerome Powell had to say a little after 3 p.m. Eastern yesterday.
The real economy, the hard data, are still in reasonably good shape. It's the soft data, it's the surveys that are showing, significant concerns, downside risks, and those kind of things. We don't dismiss that. We're watching it carefully, but, we don't want to get ahead of that. We want to focus on the hard data. If that's going to affect the hard data, we should know it very quickly. And of course, we'll understand that. But you don't see that yet.
So, Chip, I know you're focused on the fixed income space and certainly are in a wait-and-see approach based on the data as to what I'm hearing from you in this particular segment. But what does this mean for investors who do have money in the stock market, wondering how to position themselves in this more uncertain environment, as the Fed chair alluded to yesterday?
Yeah, I think from a fixed income perspective, if we expect the Fed to lower rates as we progress through the year, we do think that short dated interest rates will continue to come down slowly. I think that things like the uncertainty around inflation and tariffs will keep longer dated interest rates, like the 10-year, for instance, which is the most highly correlated to, say, our 30-year mortgage rates. They're likely to stay a little bit more elevated than they otherwise would, and we're still going to have to work through months of uncertainty around fiscal and trade policy. So in that context, we would keep duration, right, exposure to interest rates somewhat neutral at this point. We think that we're going to get some tactical opportunities to potentially take some interest rate exposure off the table or potentially add some. But given where we are right now in this news cycle, the headlines, and where we are in the progress towards tariffs, we would stay neutral at this point.
I have to end by asking you about the word transitory, right? It might bring back some rough memories for people because that's
Right.
what we heard from the Fed chair in September of 2021. And we all remember what happened throughout 2022, a drawdown of, I believe, more than 20% in the stock market, and inflation that peaked at 9.1% for consumers in June of 2022. Is there credibility behind that statement from the Fed chair yesterday?
I think there is, and it did catch a lot of attention because that's a very famous word now after the past several years. I think that the implications of tariffs could be transitory in the sense that they are used more as a negotiation tactic, and ultimately they come in a bit lower or softer than expected, or if they are implemented it's sort of a one-time price increase that would not create necessarily sustained inflationary impact. If we go back and forth, though, and there is escalation and retaliation among our trade partners and with the US, then that could create more sustained inflation. Right now, obviously, we don't know how that ultimately plays out. As it stands today, yes, I do think it is possible that the inflation impact could ultimately be fleeting or transitory, as Fed Chair Powell said.
Chip Hughey, Managing Director of Fixed Income at Truist Wealth. Chip, thanks so much.
Thank you.